Hey, welcome back to Kaz's Corner. I'm your host, Adam Kazanik, managing partner with Convergent Financial Partners. Today, we've got another episode for you for Dollars and Cents, our mini-series. And today's episode is going to be focused on the basics of investing. I know this is what you've been waiting for. Talked a lot about savings. We talked a lot about checking accounts, credit scores, all the other things. If you haven't seen those videos, be sure to check those out. But today we're going to get into the nitty-gritty, the sexy part of what I do for clients, or at least the ones that, the topics that I always get all my questions about. So first and foremost, why is investing going to be a better place for your dollars over savings? The reason why is because there's more opportunity for growth when it comes to investing. This is where we're getting into buying stocks, buying mutual funds, buying ETFs, all of these sort of fancy financial tools out there. And essentially what you are looking to do when it comes to investing is you are utilizing your dollars, purchasing an asset that is going to, if it works out, do one of two things. It's going to either generate income and pay you some sort of yield, or it's going to appreciate in value. Now, this could be real estate, a business interest, stocks, right? Which is essentially your business interest in publicly traded stocks. It also can be buying ETFs, buying mutual funds, which is a basket of all of those things put together. Regardless of the actual vehicle, the important thing is there is risk that comes along with investing. But if the risk and the return potential are aligned, then that's where things could go right for you. What we don't want to be doing is taking a whole lot of risk for very little potential return. That's not a good balance. And ideally, we would want the opposite, right? We would want to take very little risk and get a whole lot of return potential. But that's what the sort of unicorn of investing is, and it's hard to find out there, right? We all want to have a 10% rate of return year over year with taking zero risk on the downside. We're not going to necessarily find that everywhere. So we do want to understand how much risk are we taking relative to how much potential return that we're taking. So that's the high level overview. The best thing to think about when it comes to investing, and I was just recently having a conversation about this, is again, the difference between investing and trading, okay? There's a distinct difference, and the difference for me is how long you're going to hold that investment. When I think of trading, I think of a very short holding period. I'm going to buy something, I'm going to wait for it to appreciate in the very near term, and then I'm going to sell it. I bought something for $1, it went up to $3, boom, I made a great return on it. Now, you could be doing that with a lot of money or a little bit of money, but that's, as a whole, trading. Investing is going to be longer term. I'm buying this and I'm not forgetting about it, but I'm just not thinking about selling it for an extended period of time. Could be months, could be years, could be decades. Most of us are investing when it comes to retirement. It's the easiest way to get started. We all want money that is going to grow over the long term. It also is a place for us to get comfortable with the stock market because we have such a long time horizon that we're focused on. So we could be talking about 10, 20, 30 years. And just rough statistics, the stock market, which most people, when they refer to that, they're really talking about the S&P 500, the largest 500 companies on the New York Stock Exchange. The value of those companies go up about 75% of the time. So roughly every 3 years, 2 years are up, 1 year may be flat or down. But believe it or not, that's 75% of the time that the markets are up, that companies have increased their value, increased their profitability, their value to the world really is the way to look at it. And it's not too hard when it comes to investing too. Where you spend your money, where the masses of people are spending their money, those are the companies that are going to do well. They're the ones that are generating revenue, generating profit. Those are generally the companies that we would want to buy a little piece of and recoup some of that yield through dividends if they're paying a portion of their revenues out to their shareholders, or you buy that company's stock and then let it appreciate because they are building value, increasing the value they're providing to all of us across the globe over time. And that's what we want a piece of. We want something that I bought a little sliver of what XYZ company, and then over the next 5 years, that company went up in value. My little sliver is now worth more, and I can now sell it, walk away, and say, now I've made money. Now, doing that on a regular basis, buying a lot of investments, as you can imagine, there are hundreds, thousands of companies out there to invest in, knowing who's doing what, who's more profitable than others. This is really where you get into the weeds, and you can be an individual trader or investor yourself. You can then utilize somebody like me from a professional standpoint, and I will then go out and find investments that are suitable for clients, that meeting that risk and return measurement for what makes sense for your overall goals. And that's really where I think investments and thinking about investments, we could all learn a little bit more. We could all get a little bit better at it. Is we don't want to invest just to invest and take risk on something that we really don't understand. We want a reason why we're taking that risk. We want to have a set goal. So you may have seen my other video about the rule of 72. If not, go check it out. But it'd be interesting to know, okay, if I'm going to invest money, how long is it going to take for that dollar to become $2? And then that 2 to become 4, and then 4 to become 8, and so on and so forth. And having a realistic expectation. So having a frame of reference is really important when it comes to investing. But that's all that we'll get into today as far as the basics. But you want to understand, why am I investing these dollars? What rate of return do I want to get out of this? And what do I want my dollar or $10 or $10,000 to turn into, and for what purpose? When am I going to use those dollars, and for what purpose am I going to? That's really going to help us figure out, is this investment right for what I'm looking at? Is it too risky? Is it too conservative? Those are going to be questions that you want to ask yourself before you make any investment decision, or engage with a professional or somebody who can help you determine what's right for you. Next, we talked a little bit about it, is the risk and return in combination with just the common investment. So I'm going to dive a little bit deeper into that. Stocks generally are referred to as the more risky type of investment. The reason why is because the value of a share of stock, depending on the type of company, can fluctuate from day to day. A share could be worth $3 one day and $12 the next day, and then back to $8, and it could be all over the place, depending on the type of company, what they're doing. Are they in the news? Are they not in the news? What product and service are they delivering to the world? So that generally is going to be of the more risky type of, or more aggressive type of investment. And then the other end of the spectrum, you have cash, savings accounts. You're getting a fixed rate of return. You're not going to get any more or any less than what's stated on that interest rate. Yes, it could change, but it's not going to change day to day. You're going to have a set interest rate for an extended period of time. You have reliability. So the way they also think about it is, the more reliable of an investment, the lower return, because that person promising you, or that institution promising you that reliable rate of return, doesn't want to be under the hook for, if something goes wrong with what their plans were, they don't want to be on the hook to pay you 5% when they really only earn 3%. Now they've lost money. So the more secure of a result you're looking for, the lower return you're going to get, which is totally fine. That's appropriate for some assets. You also want assets on the other end of the spectrum that are going to grow more aggressively. Maybe they're more tied to the economy, so they're going to help with inflation. And if the bottle of water that you used to purchase every day from the vending machine was $1 and now it's $1.50, well, we want to have some money set aside for our future bottles of water that we want to buy that will earn money and interest to go from $1 to $1.50, so I can continue to buy that bottle of water. So you want a mix of those investments, as well as you want to pay attention to what I refer to as asset location, right? A lot of times people talk about asset diversification, right? I want to buy some real estate. I want to buy some stocks. I want to buy some bonds. I want some money in cash. I want all these fancy different things. But actually, arguably, I think what's more important is where you invest your dollars. What kind of account are you using to invest your dollars? This is what I refer to as asset location. And what I mean by it is, are you buying that stock of XYZ company in a brokerage account with after-tax money? Are you buying it in an IRA with pre-tax money? Are you buying it in a Roth IRA? Are you buying it in your 401k? All of those accounts have different impacts from a tax perspective. So I'm going to go through a few of them right now in terms of the types of retirement accounts, because that's what I spend the most amount of time talking to my clients about, is their retirement. Very popular out there, 401k. If you work for an employer and you're not self-employed, chances are you probably have a 401k. Now, you don't have to worry too much about it. What's a 401k? It just simply refers to part of the IRS tax code, section 401k, that basically details how this type of account works and how it is taxed and how you can access the money and how maybe you can't access the money. So, general high-level overview. 401ks are offered to you by your employer. You have to be employed, earning a wage, and you have the ability to defer some of those earnings. So let's say I'm making $1,000 a week. I can decide I want to put 20% or $200 of that into my 401k. A lot of employers will match what you put in there, some percentage, to incentivize you to put that $200 in my example into that 401k. So you could be earning immediate money by your employer adding to that account as well on top of your $200 in my example. A 401k has certain tax benefits. Now, there are 3 types of tax benefits to be aware of. No account really for retirement has all 3. The first is going to be deductions for your contributions. So in my example, I earned $1,000 this week. I put $200 of it into my 401k. According to the IRS, I pay taxes on the $800. Okay, I have deferred paying taxes on the $200 that I put into my 401k. I don't have to pay taxes on that this year. But as we all know, death and taxes are the 2 guarantees. So I'm going to have to pay taxes on that $200 at some point in the future. More realistically, I'm going to not only pay taxes on the $200, I'm going to pay taxes on what that $200 has grown to inside of that account. So maybe I'm not paying taxes on the 200, I'm going to pay taxes on 1,000 because over the next maybe decade, that 200 grows to $1,000. Now here's the argument. Is that better or worse for our overall game plan? Do I want to pay the taxes on 200 and then invest it and let it grow and then not pay taxes again? Or do I not want to pay taxes today, let it grow and pay taxes down the road? There are pros and cons to both. More details to come. Talk to a financial advisor or feel free to reach out. More than happy to give you those types of details. But it's important to have an understanding of these tax benefits. Second tax benefit is what's happening as the money's growing inside the account. There are 2 ways that it can happen. One, the money grows year to year and you don't pay taxes on the growth. This is what we call tax deferred growth. You're deferring paying taxes to a later date. You also then have taxable accounts, which are not tax deferred. Every year that account grows in value, you have to pay taxes on that growth. You may realize this when you get a 1099 tax form from your bank account, from your savings account. A lot of people that I talk to are using high yield savings accounts, earning 4.5%, 5%. At the end of the year, they're going to get a 1099 saying, hey, congratulations, you parked this money in the savings account. It earned interest. You owe the IRS taxes on a portion of that interest. So important to understand and balance. Do I want to defer taxes for at some point in the future, or do I want to pay taxes ongoing? It's not a right or wrong 100% of the time. Generally, the answer is you want a balance of both. And then the third tax benefit that an account can have is tax-free distributions. When I take money out of this account at some point in the future, do I pay taxes on it or not? And there are some accounts that you do not need to. This is where a Roth IRA would come into play versus a traditional IRA. So 2 different things that we'll get into. Traditional IRA, you're putting money in for the benefit of deductions. I put $1,000 in. I don't have to pay taxes on that $1,000 in that year. The money can grow tax deferred. That $1,000 can become $10,000 in the future. But when I want to access that $10,000, there's some special rules that we have to follow. One is you got to wait until 59 and a half. That's the current IRS rule that says any tax deferred account, because you didn't pay taxes when the year that you earned the money, and because you didn't pay taxes on the growth, you got to wait till 59 and a half. You got to leave it in there long enough to that day. Now, it could be a year for some of the older individuals. It could be 30 years for younger individuals when they're contributing to these accounts. Important number to know. But when you take money out of a tax-deferred account, you pay taxes. And you pay taxes at your normal income rate. So think about it as I get to whatever age, 60 plus, I take $10,000 out of an IRA. The IRS looks at it as if I've earned that $10,000. So I need to pay federal and state taxes on that $10,000 distribution. With a Roth IRA, it's sort of the opposite. What you're doing is you're strategically paying taxes up front, and then you never have to pay taxes again, because I paid taxes, as some people refer to it, on the seed and not on the harvest. Where a traditional IRA, you never pay taxes on the seed, so you're going to have to pay taxes on the harvest when down the road it has grown and appreciated into a higher number. Now, the good news about it is you can control how much you take out of that account in the future. So you can control, for some individuals, you can control how much taxes you're going to be paying, because I can decide I want to take 10 or 50,000 in a given year out of that account. But if you have all of your money in only one type of account, let's say all your money in a 401k, you don't have a whole lot of options, because you don't have a tax-free account to go to. You don't have another account. So you want to have all three buckets. Tax deferred, like an IRA or a 401k. Tax-free on the other end of the spectrum, like a Roth or maybe life insurance cash value. And then you want that middle of the road, which is a taxable account, your savings account, your checking account, your brokerage account. The money that is accessible, that you can go and access without having to pay taxes on it, but you've paid taxes along the way, right? So pay taxes in the future, pay taxes along the way, pay tax up front, and never again. Those are kind of the three categories of accounts. What I refer to as asset location. You want to diversify your asset location. So to turn it back to you, think about what accounts you're using. Do you have all three accounts in your portfolio? Are you utilizing strategies to make sure that you are balancing your nest egg or your portfolio, to make sure that you have some money that you're getting some deferral on your contributions, some money that you're growing and saving for the future that could be tax-free, and then also money that is most available to you at any moment in time? But yes, the downside is you're paying taxes on any growth that is realized along the way. So, food for thought for you. Hopefully this episode was helpful. There's a lot of rabbit holes and nuances to go into, but this is just a very high level around investing, the types of accounts that you can utilize to invest, as well as also the investments that you can select within each of those accounts. So reach out, interact, want to make sure I can answer any questions. We'll see you on the next one.